What's up everyone, it's Caddy with One Investing. So in this video, we are going to be talking about a new report by FactSet that pretty much puts together the earnings estimates for the first quarter 2023. So we're going to be talking a little bit about what analysts have been doing in January and February, and have the earnings estimates been coming down? Have they been staying higher? What is actually going on with earnings estimates for 2023 as a whole? And we'll talk a little bit about individual sectors as well, because at the end of the day, markets are nothing but a multiple of earnings, so we have to focus on the underlying earnings, which is the net income for all these companies. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below. Later today, I will be sharing a video for all the members in our Patreon going over 4 to 5 different trade ideas potentially coming up for a lot of individual stocks. So if you want to take advantage of that, get buy and sell alerts, options alerts, swing trading ideas, and private videos, links to our Discord is going to be down below. So, given the concerns that the market is about to hit an economic slowdown or a recession, analysts have been lowering estimates more than normal for S&P 500 earnings. And during the months of January and February, analysts lowered EPS estimates for the first quarter by a larger margin than average. The Q1 EPS estimate, which is an aggregation of the median EPS estimates for all S&P 500 companies, decreased by 5.7%. To $51.13 in the first couple months, and that's down from $54.20 from December 31st and February 28th. So we are seeing a bit of a decline in EPS estimates. In a typical quarter, analysts usually reduce earnings estimates during the first 2 months of the quarter. During the past 5 years, 20 quarters, the average decline in EPS for the quarter has been 2.3%. And during the past 10 years, which is 40 quarters, the average decline has been closer to 2.7%. And during the last 15 years, which is 60 quarters, the average decline in EPS estimates have been closer to 3.4%. So this is by far much higher than all three averages, the 5-year, 10-year, and the 15-year averages. And during the last 20 years, which is 80 quarters, the average decline in EPS estimates was closer to 2.9%. Thus, the decline in bottom EPS here that we are seeing in the first quarter of 2023 by the analysts is much bigger than all those averages. And the only time we can go back was during 2020, during the COVID pandemic, when Q2 of 2020, we saw a decline of over 35.9%. And at a more sector level, 10 of the 11 sectors witnessed a decrease in their bottom EPS estimates for the first quarter, and led by materials, minus 12.6%. Let me just go over and share that chart with you guys. So this right here is the chart that FactSet put together, and this is the change in the sector level calendar year 2023 EPS. And this is not for the first quarter, this is for the entire year, by the way. And what you'll notice is that we are seeing only consumer staples that push higher, 0.2%. Every single sector is down. This is based on analyst estimates alone, based on FactSet and what they're expecting for 2023 EPS to basically grow or come down, right? That's the change that they're expecting in earnings per share. And consumer discretionary is down the most at 6.3%. Now, what does this tell you? What does this picture tell you? From just by looking at it, you should already start to pick up and know that if analysts are expecting that consumer discretionary is going to be down 6.3%, right? That's the negative growth. In other words, that's the contraction in earnings. And consumer staples are actually going to be higher, or they're going to hold up a lot better. Utilities are going to hold up a lot better. They're only going to be down 0.3%. What does these two sectors tell you? Well, they tell us that there is going to be potentially a recession. At least that's what investors, analysts are expecting from the economy in 2023, because consumer staples and utilities are very recession-proof names, right? So consumer defensives and staple stocks and utilities, I mean, those are things that you still really need, right? You can't get around from buying groceries and utilities and electricity and water. Like, you still need those things. But when it comes to IT, when it comes to, consumer discretionary stocks, of course, these are discretionary spendings that can be pushed back, that can be delayed. And as a result, earnings are expected to decline for this particular sectors. This is going to be the Q1 2023 bottom EPS estimates, and you'll notice that we have been coming down since since beginning of this year, and even if you go back to 2022, it's been coming down from $54.20 to pretty much down to where we are right now, and the markets have been pretty stable at around 3940, 4000. We're kind of hovering between 39 and 4000 points for the market. So, I'm not saying that the market has to absolutely come down as earnings are rolling over, as earnings estimates are coming down. But we have to understand that the market starts to become more and more expensive as earnings come down. It's a simple, math behind it. It's a simple multiple, because the markets at the end of the day are nothing but a multiple of earnings. And as earnings itself are coming down, we have to be very cautious in our understanding of whether the S&P 500 is trading at an appropriate value, or is it all of a sudden trading at a higher value than what it needs to be trading at. This is going to be the first quarter 2023. So once again, you'll notice that materials, they mentioned, we're down the most, 12.6%. Then we got healthcare, discretionary, industrial, energy, and utilities are the ones that they are expecting for very strong growth. In other words, earnings per share growth in Q1 2023 versus same time last year at 3.1%. And financials to hold up a little bit better as well. But they are expecting for the entire year to staples to be the big winner, along with utilities in terms of earnings, not in terms of stock gains or anything else, in terms of earnings for that growth on a year-over-year basis. Now, this right here is going to be another chart that we have already gone over. This is going to be for the entire year, calendar year 2023. So what you'll notice here is it's down from $230 in earnings per share down to sitting roughly at $222, right? So we also talked about Yardeni Research and how they've put together a report which pretty much also suggests that 222 is going to be that number. But my question to you today is that, are we going to stop at this level? That's my question to you. Comment down below and let me know what you think. But my question to you is, if we have been coming down from $230 and we're now down to $222, is this where we stop? Is this where it starts to go sideways and we stay flat at $222? Or if earnings continue to contract, or at least the expectation for earnings continues to contract, and when the real earnings are actually reported, do we actually see a bigger contraction, a smaller contraction, or if we actually see on point at $222? Because that's really what's going to drive the valuation at the end of the day, right? This is going to be the whole chart that I've shared with everybody in the past, and we've also talked about it in our previous videos. But if you take a look at S&P 500 right now and where we are, we're sitting at 4,045, right? So 4,045, if you plug that number in, and if we go over to the earnings on a forward basis and 2023 basis, I've plugged in 222 because that's where we are right now. And we're right now sitting at over 18 times earnings. But again, my question to you is the earnings per share for 2023 is actually going to stay up at 222? Or analysts still have a lot of work to do to bring that lower, considering the higher interest rates? Are we going to actually see a lower number? Because if we are, we need to be prepared for that. So if you go over to 210, now all of a sudden we're trading at over 19.2 times earnings. If you go down to 200, now we're trading at over 20 times earnings, which if you were to recalibrate down to 18, obviously means more potential downside for the market. Now, on the contrary, right, if the earnings come in super strong, let's say, we get a soft landing, inflation goes away by the end of this year, consumer spending is rocketing back higher. If you get up to, let's say, 250, and then all of a sudden market's super cheap at 16 times earnings, right? It's super cheap. Earnings are growing really nicely. So for us to get back up to, let's say, 17 or 18 times, that would mean 4,500, 4,600 on the S&P 500. But the real question really is that, can earnings hold up in this macro environment? The answer is yes. The markets are fairly valued. In some cases, some arguments, they can even be considered undervalued. But if the earnings don't hold up, and it doesn't look like they are, considering that the estimates have been coming down, and there's a lot of other analysis being done around S&P 500 earnings, and of course a lot of sectors pulling back, contracting. Energy is going to start to roll over a little bit. They were the big contributors to the higher earnings growth last year. But if they start to roll over, then there is definitely a pretty significant case to be made that the market's valuation can seem a little bit on the high end, considering how quickly earnings are coming down. So let me know down in the comment section below. But first quarter 23 numbers are in, and it doesn't look super great, especially when you are expecting a decline of over 5% on an aggregate basis. So 5.7% is that number right here for first quarter 23. That's the S&P 500. And for the entire year on S&P 500, it's expected a 3.4% decline for the entire year versus 2022. So hope you guys enjoyed this video and a complete update on this particular earnings. Let me know your thoughts down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Happy investing, and I'll see you all in the next video.